Hello, everyone. I appreciate your time today. I'm very much happy to present my paper here at Stockholm. This paper examines whether venture capital investors address the climate risk for their investment strategy. Let me introduce my research question first and move on to rest of my presentation. All right, this paper finds its motivation from the linkage between the two lines of studies, where the first line asking about climate studies, asking about whether both institutional and retail investors incorporate the climate risk for their investment decision, where the second line of literature is on the venture capital investors and how they change the investment strategy and how could potentially impact the real outcomes of their portfolio companies. So I asked myself, what if there's an exogenous shock that can what if there's an exogenous shock that can change the perceived level of climate risk, and how could this potentially impact the venture capital industry and their portfolio companies? So to briefly preview my findings before I proceed further, after the shock that I'm using, the VCs actually tend to increase investment level on the green startups, where the green startups tend to increase the level of green innovation after the shock, while the brown startups who fail to do this get penalized from the VC investors. And if I narrow down my focus on the startups on the energy sectors, they tend to increase the green innovation as well, but while receive no less amount of funding in the increasing shift on the VC investment after the shock. And if we look at the long term, then it is only the green startups that's funded by the experienced VCs who makes a successful exit. All right, so hopefully by now, I think we all agree that climate risk has gained unprecedented attention from every aspect of the market participants. So I think this is not something that's happening just all of a sudden, and actually not only restricted to the public market exclusively. According to the Clean Tech Group, which is a private research company on clean technology and innovation, their data shows that the VC investment on clean technology recorded $36 billion in 2019, which was more than a double count, which was recorded in 4 years ago, which is in 2015. So ideally, the capital flowed into those clean technologies should boost the development of the level of green innovation and reduce the relative price of using those clean technology. However, although the VC-backed startups are actually one of the huge drivers of the innovation in our economy, climate risk studies using on the venture capital scope is not actually highly undiscovered relative to the studies using the public market setting. I think this is because it is still unsure whether those clean technology and green innovation would have increasing effect on the wealth of the shareholders. And second, many of those green startups are fundamentally different from the software companies in terms of building the biofuels and physical goods. So if the VCs just try to apply the same financing model to those green startups, they are highly uncertain whether they can expect the same amount of expected returns in the future. So the question is, what if there's a shock that can alter the level of change in the level of green innovation and boost the development of the green innovation level per se? So I focused on the environmental plan called the State Climate Adaptation Plan, which is initiated by the 15 states in the United States. I focused on this plan for two main reasons. First, according to my knowledge, it is pretty much difficult to find an environmental policy implemented at the federal level in the United States. Second, although it's implemented by 15 states in the United States, this includes majority of my sample of VC investors and startups in my data set. So what does this SCAB do? The purpose of the SCAB is to address the corporate climate risk and raise the awareness of the climate risk to the local startups and businesses through the following 3 steps. So first, planning and capacity building. Second, law and policy. And 3, post-implementation monitoring. So as you can see, these all three steps can have direct and indirect impact on the local businesses and the startups and investors, and raise the awareness of the climate risk at the same time. So essentially, we can expect the three main consequences from this plan. First, if the SCAP turns out to be successful, then ideally it can reduce the level of perceived corporate climate risk, boost the level of green innovation, and send a positive signal to the investors as a public safety net. Whether second, it can also be a challenge for the local startups and investors, and in terms of the compliance cost, and lead them to even more financially constrained, shrink down their innovation strategy, and make them walk away from investing in risky projects. Third, if this is highly irrelevant to climate risk and investors and startups does not address at all, then we might be able to observe any significant impact on those startups and investors. So then, what's the economic mechanism? How can this SCAP impact the VC industry and the startups? What would be the economic mechanism behind this? First, I think if the SCAP turns out to be successful, I think it can provide a favorable conditions for local startups to become even much more greener. I think this is because in the perspective of the startups, under the existence of the information asymmetry between the investors and startups, those startups have to convince their investors that they are capable of adjusting to a newly adopted environmental policy, demonstrate their alignment, and show them how can they benefit from the plan. However, in the perspective of the VC investors are, in the perspective of the general partners, have their responsibility, fiduciary duties to their limited partners to show them their responsibility of screening and sorting out those profitable startups in the long run. So as a result, I would believe the SCAP adoption will increase the level of green innovation, initial level of green innovation outcome by the local startups. Where the second, the purpose of the SCAP is to reduce the corporate climate risk and raise the awareness of the climate risk to the local investors and businesses. So it can provide green startups a comparative advantage, I would believe, because the investors who recognize the importance of the climate risk would highly prefer the startups with more sustainable outlook after the newly adopted environmental plan. So investors who recognize the importance of the climate risk would prefer the startups with more sustainable outlook, whereas conversely, at the same time, it can impose the huge disadvantage for the brown startups in terms of their VC fundraising, what they can actually raise in the future. So my second hypothesis is that after the SCAP, green startups will be highly rewarded by the venture capital investors, whereas brown startups will be highly penalized from them. Third, I think this is also in line with Dr. Kaperzak and Harrison Hong's paper, that the ESG innovation disconnect is highly prevalent among the energy industries. I focused on this ESG innovation disconnect and energy companies because those energy companies are usually considered as major pollutants of our economy, but at the same time, if you look further, they are also a huge driver of green innovation at the same time. Even though with those contributions, I think those energy startups, energy companies are usually often get excluded from ESG funds, which is a puzzle for the policymakers and ESG-focused agendas. So I also examine whether this channel holds for the private companies and expect that energy companies will also increase the green innovation but fail to receive larger funding, what the other green startups as what they do. My last hypothesis is that under the uncertainty on the economic value, real true value of the green innovation, it is still uncertain whether those green innovation could have positive impact on the wealth of the shareholders. So with those highly uncertainty, it may be uncertain whether those green startups received higher funding after the SCAP, which is an exhaust. It is highly uncertain whether those green startups who received larger funding would eventually make a successful exit in the long run. So I think this is where the moment where that VC investors' strict monitoring and screening becomes a really precious for those green startups. So I would expect the green startups will have only successful exit only if they are funded by the experienced VCs. So in order to do that, I construct a data set from 3 main sources. First, VC investment data set comes from the venture expert, which is known as Refinitiv nowadays, which gives me about 37,000 unique startups and approximately 119,000 round-year observations. Innovation data are mainly from the United States Patent and Trademark Office and its sub-platform called the Patents View. Green innovation also comes from the following the guidelines of the OECD. Also, I include the violation records data set, which comes from the violation tracker data set provided from the Good Jobs First. Also, to implement the empirical analysis, I mainly use the difference and differences setting by referring the 2 main following studies. I chose diff and diff because of the 2 reasons. First, I can compare the startups that's been affected by the SCAP from the unaffected startups. At the same time, I can also compare the startups that's affected before and after the newly adopted environmental policy. So in addition to the main fixed effects, I also include the lead VC fixed effect in my model because those lead VC investors are usually the ones who take in charge of the strict monitoring for the specific company within a specific syndication. So as a first step, I study the impact of the SCAP, how this can affect on the local green innovation made by the local investors, local startups. And to do this, my primary interest of 3 variables are green patents per se, and the ratio of the green patent to the total patent outcome, and the total patent outcome itself as the last measure. So after the SCAP adoption, I find that it significantly impacts the green innovation, level of green innovation made by the local startups, which increases by 60% compared to the sample average, whereas it also increased the ratio of green patents by 50% compared to the sample average. But meanwhile, one thing we have to keep in mind is that the SCAP exclusively impacts on the green innovation while having no impact on the overall innovation from the local green startups. This is because I think it justifies that this specific exogenous shock has only impact on the green innovation itself. And next, to investigate whether this newly adopted environmental policy do lead VC investors to promote their investment on the green startups, I construct a hypothetical VC investment data set, which is constructed by matching the counterparts, mainly following the 2 following conditions, where the deals made by 30 days to prior actual deal and the deal startups that's included in the same industry. So after the SCAP, it significantly raises the investment on the green startups by 1%, which is 50% increase compared to the sample average, which clearly shows that the preference on the green startups for the VC investment toward those green innovation clearly satisfies after the SCAP. So with being those highly preference on the green innovation and green startups being confirmed after the SCAP, I next pin down the scope to the green startups itself. So I define the green startups by the startups that has green patent applications at least 3 years before they receive first round of VC funding. So I implement those same identification strategy and check how the SCAP adoption affects the level of innovation and VC investment those green startups tend to receive. According to my findings, after the SCAP, the green startups tend to increase the level of green innovation by approximately 6 times. This is also supported from the ratio of the green innovation by approximately 8 times. Also, they tend to receive more VC investment by 1.6% compared to the sample average. One distinct result compared to the prior findings is that the overall innovation patent outcome actually decreases after the SCAF for the local green startups. I think this is because focusing their strategy on the green innovation is highly costly and make them to fail to balance their overall innovation portfolio for the local green startups. I also implement the same identification strategy and test for the brown startups by defining the brown startups as the startups with an environmental violation record during the VC investment horizon. And I find the result that unlike the green startups, brown startups tend to deviate from improving their green innovation. So they have the decrease in green patent by approximately 3 times compared to the sample average, while receiving less VC amount of funding by 10.8 times, 10.8%. So again, this also supports, this evidence also gives supportive evidence that the hypothesis that scab adoption will impose highly disadvantage for the brown startups in terms of the compliance cost and could be a significant financial burden for those brown startups. However, meanwhile, I next pin down whether there's a significant difference that could be captured if the experienced VCs actually engage in. So I follow the 2 prior studies and define the experienced VCs as the VC investors who led their portfolio companies to more IPOs above the market average. And the result is pretty much surprising that the green startups that's funded by experienced VCs only have increasing significant impact on the overall innovation outcome without any impact on the green innovation. While if we focus on the scope to the brown startups, it's highly similar to what we have found from the previous findings. So I think this implies that experienced VCs has particular role in terms of the green innovation and gives a potential clue that there could be a significant difference in terms of the outcomes for the green startups whenever the experienced VCs actually engage in. So in order to provide additional evidence on those potential significance, I also examined 2 additional channels, which includes the startup's debt accessibility and the historical violation record. So I focused on the secure debt channel for the 2 main reasons, where first, due to the financial frictions and information asymmetries, startups who can be really successful on pledging their intellectual property for their collateral can really take an advantage on using the external debt channel. Whether second, I think this is also the moment where the venture capital investor's role as an intermediary becomes really precious in terms of strict monitoring and screening. So as we can see, the findings suggest that the likelihood of debt usage on the secure debt usage only increases from the green startups funded by experienced VCs, while having no impact on the first and the second group with the total sample and the green startup sample. Next, I also examined the channel of violation records. This is because from the prior studies, it is said that when companies face extra financial pressure, it is highly likely that they will tend to engage in much manipulation in real activities. So despite the green startups tend to receive more funding after the scab adoption, still it is highly financial burden in terms of a compliance cost. I would assume that those green startups would behave significantly different in terms of the manipulation activities compared to the green startups that's funded by experienced VCs. And just like what my expectation has suggested, the finding actually shows that green startups tend to engage in more manipulation activities after the scab adoption in terms of the consumer protection and employment relevant offenses, whereas it shows no significance and opposite significance from the sample of the green startups that's funded by experienced VCs. Also, for the hypothesis on ESG innovation disconnect, I focused on the startups that's in the energy industry using the same identification strategy. And according to the results, the findings suggest that although energy industries, startups in the energy industry tend to increase the level of green innovation outcome after the SCEP adoption, also that's supported from the ratio of the green patent and patent applications, but however, they tend to receive no further evidence on the higher VC funding amount, just like what other green startups actually did. So this also clearly suggests that innovation disconnect holds under the private firm setting as well. Now, under the uncertainty on the green innovation and its impact on increasing the shareholder wealth, I next explore how those green startups that's raised more VC funding after the SCEP would eventually make a successful exit in the long run. Just like the hypothesis, I can only observe the more likelihood of making successful exit on those green startups whenever the experienced VCs actually engage it in. While meanwhile having no impact or have lower likelihood on IPO whenever those green startups are not funded by experienced VCs. Whereas in terms of the space, I didn't really include it, but brown startups also have 15.4% lower likelihood of making successful exit and 10.2% of lower likelihood on IPOs. So to test the validity of my DID estimator, I also test on the parallel trend assumption and have no significance from the pre-trend assumption, while having only significance from the post-implementation period. And in order to do the robustness check on the staggered DID adoption, I also do the stacked approach following the Gomli and Matza. And my three main primary interest of variables stay robust on those stacked approach as well. So to conclude, I find significant variance and supportive evidence that SCEP adoption significantly impacts the local startups and VC investors in terms of the green innovation. I highly appreciate all of you to inviting me to Stockholm today, and I very much look forward to productive comments from my discussants. Thank you so much.
So I have a bit of a cold, as you can hear. So if my voice breaks and I sound like a teenage boy, I apologize in advance. But thank you very much for inviting me to discuss this paper. The paper is called "Do Venture Capitalists Value Climate Risk? Evidence from State Climate Adaptation Plans." So my name is Katarina and I'm at Copenhagen Business School. So this paper centers around state climate adaptation plans. So this was a new concept to me, so I will focus a lot upon what these plans actually are and what they do. But what it is, the intention of these plans is to address climate change, the impact of climate change on society and on the economy. So it's like we accept that climate change has already happened. Now we want to minimize the adverse effects of this. So it's not about mitigation, which is what we often think about when we talk about green investments. It is about adapting to this new reality. This is a consequence of, because we can observe all of these adverse impacts of climate change. So we can observe an increased frequency of floods, heat waves, droughts, wildfires, but also sea levels rising. And you can see some examples here. And the objective is to protect people and property from these negative effects, essentially. So what the commonality between all of these states' plans, or the different plans across different states, is they want to create a resilient economy and a resilient society that is less vulnerable to these risks. So create a foundation for sustainable economic growth. And then what Hyeonjoon asks is, how does these plans affect the entrepreneurial ecosystem? So does it have any impact on startups' innovation policies? Excuse me. Does it affect VC's investment strategies? But also, does it have any impact on startup success and what they do? So what Hyeonjoon does is that he studies the response in these innovation policies and VC investment strategies to this staggered adoption of these state plans. So the baseline specification looks like this. It's a two-way, essentially, fixed effects, diff model, with a lot of different outcome variables, and with the SCAP adoption event as the main sort of variable of interest. It's a very ambitious paper. He looks at a lot of different outcomes, as you could see in his discussion. He looks at both startup outcomes, VC outcomes, tries to link it to a lot of previous results in other sort of market segments, not the private markets. And he finds a lot of interesting results. So he finds that startups respond to this event by increasing their green innovation output. The way he measures green innovation output is through this OECD algorithm that is quite common within a lot of the literature. It's applied. What this identifies is it's primarily innovations that would facilitate transition, which would have to do with mitigation rather than adaptation. He also finds that startups do increase green innovation output at the expense of total innovation output. Startups are also more likely to raise VC funding. It's easier to raise venture capital following this adoption. And in particular, these financing constraints or the market is much more easy for green startups to raise capital, but brown startups receive less VC funding. So the way green startups are defined is by having green innovations already. Brown startups are identified through violations of sort of climate regulations or biodiversity regulations or whatever it could be. So they have received a fine or some sort of penalty. The effects when you look at startups funded by experienced VCs are quite different from when you look at the sort of the larger economy or the larger market. But and in general, this SCAP event has no positive effect on green startups' exit performance unless they have already been funded by experienced VCs, unless they're funded by experienced VCs. But as you can see, a lot of these results center around these SCAP plans. So I'm going to go through a little bit what these plans actually are, because it's quite important to understand in order to understand these results. So I read a lot about it, because it was new to me, especially this distinction between adaptation and mitigation. So here, adaptation in this context, and this is taken from the California plan, generally refers to efforts that respond to the impacts of climate change. So the primary focus is to address the consequences of this. So climate change is a fait accompli. We can't do anything about it. Now we have to make our society resilient to all of these changes. Some states, so this is important to bear in mind too, have an integrated perspective on this. So Alaska, for example, when they adopted this plan, they focused on both mitigation and adaptation at the same time. California didn't. They only had an adaptation plan. This is not because they don't care about mitigation. It's because they had already done it in other bills or other policies or other plans. So it's not one uniform policy. There's a large variation across states here. So there's this Georgetown Climate Center who looks into these plans, and they provide a lot of very useful information regarding these plans. And they have sort of structured how to classify these plans and what they do. They used these 3 different categories to sort of identify this heterogeneity: planning, content, and implementation. And I will discuss this a little bit further. If we start with planning, there's a lot of variation in what the driving forces between these plans are. Who is behind it and what events kind of kicked off the sense of urgency that made states legislators to actually start thinking about this. That also feeds into who is involved in the development process. So California involved everyone. They had a very ambitious strategy to include both politicians, agencies, researchers, but also citizens. In other states, that was less important. And also the legislative process itself can be very different. So it can either be through executive or legislative action. But then also in terms of content, they vary quite a lot. In particular through the objective, which I already talked about, adaptation or mitigation, but also in ambition. So some of them have a very large scope, some of them have a very small scope. But also in the type of goals and actions that they list within these plans. So some can be very unspecific and be like, we want to stop floods from impacting people. But others can be, we have to build this wall to stop these floods from going through. Also in terms of which sectors they're targeting. Of course, there's a large variation which sectors are present within a state. But in some states, they only focus on one sector that is actually that it operates within the state. In other sectors, they just address everything. But like clearly, a state without any coastal regions, they're not going to address any coastal region issues. Then there's also, so this is about implementation and more about how they plan the implementation. So some of them actually have plans for revising and following up and monitoring progress, but other states kind of just ignores that and just writes down a lot of lofty goals. So this is adapted from a report by this Georgetown Climate Center. They vary a lot in terms of the number of goals, but also in how they sort of focus their attention. So this relates to what Hyeonjoon talked about before. So the most popular one to focus on is planning and capacity building, which relates to increasing awareness of both climate risks, but also climate change, or building making it easier for people, but also corporations, to plan for these climate risks, to plan, to know how likely these risks actually are at materializing, etc. But then other states focus more on law and policy. So they would actually change the legislation, impose fines on offenders. And this can sort of have two different effects a little bit. It can reduce regulatory uncertainty, but it can also increase the regulatory burden for a lot of these startup firms. So it can be more difficult to expand to certain regions, etc. And then they also vary a lot in this implementation monitoring, but as you can see, there are very few states who actually care about that at all. So, given how heterogeneous these plans are across states, it's a bit unclear how they should affect startups. A lot of startups or a lot of states are focusing on this increased awareness and improving knowledge. But the objective, or at least the stated objective, is about reducing actual climate risk and increase resilience of the state and the society and the economy at all. And these are the two ones that Hyeonjoon focuses on. But they have a little bit different expected impact on the startups themselves. So the first one would probably create a shift in demand because startups would actually become more. It would change which type of projects actually have a positive NPV. So you would expect green startups to become more attractive investment opportunities. Whereas if you just reduce climate risk overall, that would just create a better business environment. And Hyeonjoon's results suggest that both of these two are at play, but I would expect that there are a lot of discrepancies across different states, given how, depending on how they actually implement these adaptation plans. Then I already talked a bit about resolved regulatory uncertainty, etc. But one thing that I would also think is quite interesting to look at would be, since we're shifting from mitigation to adaptation, it would probably have an impact on what type of innovation projects these startups are going to engage in. So solving climate change or mitigating climate change might actually become less of a focus, which might lead to less investments in green projects, which is what Hyeonjoon finds with experienced VCs. But unexperienced VCs, they seem to just throw money after anything that can be considered green. But it is a bit unclear what goals and actions are most effective in achieving these two different things. And this heterogeneity also leads to a lot of empirical challenges. So I'm running out of time, so I'm going to be very quick. But there is reason to believe this is a figure that I'm borrowing from Baker and co-author's paper, where we're probably to be in this situation, where we have a staggered implementation, dynamic treatment effects, because this is a long-run implementation, and also different treatment effects across these firms, or across different states. So just the rate of the dynamic process is going to be different across all states. That's going to lead to very biased estimates. And Hyeonjoon addresses this by using a stacked approach as the baseline. I would genuinely recommend to do this throughout, or to use this as the baseline, not just as a robustness test. I'm sorry. The results seem to hold when you apply this stacked approach, but also looking at these other alternative estimators would make me a bit more comfortable in knowing that this is actually a positive, that what we're actually, the sample entities you're actually finding are actually robust. But I actually think that this can actually be a source of, or an opportunity for you to take this paper a step further. Instead of focusing on this sample ATT, actually look at these events separately. Because then these estimates are not going to be biased, and you're going to have a distribution of treatment effects. And then you can analyze this heterogeneity to understand how these different plans with different contents, etc., are actually going to affect how they have a differential effect on the startup firms themselves and the VC's investment strategies. So I'm over time, I'm sorry. Thank you very much, and I'm happy to talk to you a little bit more after.